Do you know what's the only thing constant in life is change? And if there's one country that truly embodies this philosophy, it has to be India. A land where age-old traditions meet cutting-edge innovation, where ancient wisdom collides with futuristic dreams. A decade ago, India was seen as a rising power, a rapidly growing economy on its way to becoming a global leader. Today, it stands as a testament to that potential, showcasing remarkable progress on multiple fronts. But one sector has truly captured the world's attention: Indian startups. From 2016 to 2021, India saw a surge in startups. Every day brought news of a new unicorn, a company valued at over $1 billion. There were 39 of them in 2021 alone. We were told this was proof of India's economic strength, its vibrant democracy, its young population, and its digital prowess. But what happened next? Massive layoffs, funding winters, unicorns melting down. All of a sudden, they are no longer the darlings of the media. In fact, many of them are struggling to survive. So here's the story of how India's startup ecosystem went from boom to bust, and why their downfall is not necessarily a bad thing. To really understand what happened, we have to go back to the start, all the way back to 2016. Back then, three things converged perfectly in India. Number one, a growing middle class. More purchasing power. Number two, smartphones became cheaper and more widespread. More people came online. And number three, investors had a lot of money. Low interest rates and easy credit meant venture capital poured into promising ventures. You know, the ones that promise big dreams but don't always deliver. In this atmosphere, Indian startups flourished. They tackled long-standing problems. Think about it. Until Zomato and Swiggy, ordering food meant waiting for hours or dealing with unhygienic street food. But these delivery services made eating out convenient. Before Paytm and PhonePe, sending money was a hassle involving bank transfers, ATM queues, or carrying wads of cash. But these apps streamlined payments with just a few taps. Byju's and Unacademy made education more accessible too, especially in a country where quality education wasn't available to everyone. These companies didn't just solve problems, they did it in style. With user-friendly designs, quirky marketing, and promises of disrupting industries, Indian startups became synonymous with innovation. Their growth seemed unstoppable. In fact, their expansion was rapid. Do you remember Ola cabs? They started small, offering auto rickshaws and cycle rickshaws in Bangalore. Now they dominate India's ride-sharing market. Similarly, Imarticus started with basic financial courses. Today, they offer specialized training in data science and AI. This expansion wasn't random. It was aggressive, ambitious, and often reckless. They wanted to capture the maximum market share first. Profitability could wait. It also helped that these companies presented themselves as mission-driven. They talked about empowering consumers, driving financial inclusion, and democratizing education. Investors lapped it up. After all, who doesn't love a feel-good story along with a great return on investment? But behind the scenes, things weren't as rosy. Most of these startups were burning cash. You know, spending more money than they made. They took on massive loans, raised huge funds, and extended massive discounts. Why? To get more customers. In the startup world, they call it acquiring users. The logic is simple. If you spend money today, you'll make more tomorrow. But what happens when that equation doesn't hold? When the cost of acquiring customers is higher than the revenue they bring in? That's precisely what happened. Many startups overdid it. They took on debt they couldn't handle, spent money like it was infinite, and compromised on quality. Let's take Oyo Rooms, for example. They grew fast, entering cities and towns across India. But they expanded too quickly. Their properties suffered, so did their reputation. Then there's Quicker, a hyperlocal delivery service. They promised lightning-fast deliveries in minutes. Sounds great, right? But they couldn't sustain it. Think about it. How do you deliver groceries or packages within minutes unless you have a fleet of drones or teleporting technology? Yeah, exactly. And those who didn't focus on fundamentals suffered. Grofers, for example, shut down its grocery delivery business in several cities. Fabindia, a popular fashion retailer, declared bankruptcy. And that's the harsh reality of startups. It's a high-risk game. For every success story, there are countless failures. But that's okay as long as the successes make up for it, right? Well, not anymore. The party ended in 2022. Let's set the scene. India and the world were still recovering from the pandemic. People were getting back to normal, but something had changed. Global interest rates went up, money was more expensive, venture capital dried up, and this is where things got tough. Startups that had managed to raise millions were now struggling to stay afloat. They had two options: either prove that they could make money or pack up shop. Byju's is a perfect case study here. For those who don't know, Byju's was India's biggest startup. They taught 150 million students, employed 100,000 people, and were valued at $22 billion. That's right, billion. Imagine showing your parents your bank balance and seeing that amount. They would probably faint. But it was all based on future projections. You know, what the company might earn, not what it earned now. And in 2023, reality hit. Byju's was sued for deceptive trade practices. Their investors wanted to exit. Employees weren't paid on time, and reports surfaced of Byju's trying to bribe a lender. All this while, their classes were running late. They couldn't even afford stationery. Talk about an ironic fall from grace. Ola is another good example. They had humble beginnings but quickly rose to become India's top ride-sharing platform. But in 2022, they too faced the heat. They laid off employees, closed down food delivery, and scaled back their electric vehicle business. Their founder, Pavish Agarwal, went from being a celebrated entrepreneur to tweeting about his struggles. Swiggy, Zerodha, and Farmeasy faced similar challenges. Some scaled back, some merged, some fired employees. It was a survival of the fittest. Now some say it was a bubble, a boom that was bound to burst. They talk about unchecked valuations, reckless cash burn, and blind faith in scale. Others point fingers at government policies and economic uncertainty. But maybe it's a bit of everything. The question is, should we be worried? Are these startups beyond saving? Well, not necessarily. Bubbles may burst, but good businesses survive. Take Zerodha, for instance. They're one of the few fintech companies that stayed clear of the speculative frenzy. Sure, they grew, but they focused on building a sustainable business, not just chasing funding rounds. As a result, they're well positioned for the future. Or consider Digit Credax. They've been around since 2014, offering loans to small businesses. They've navigated the startup ecosystem for almost a decade. Now they're expanding, focusing on profitability and weathering the storm. You see, not all startups are doomed. The ones that focused on fundamentals, that built good products and found a way to make money, these are the ones that will stand the test of time. So, is the death of Indian startups a bad thing? Not really. It's like pruning a garden. You remove the dead branches to make way for new growth. Sure, some casualties are inevitable, but that's part of the cycle. What about the rest? The ones that didn't make it? Well, their demise is nature's way of recycling nutrients. Their failure, like fallen leaves, nourishes the soil for future ventures. This might be a good thing because startups thrive in adversity. Necessity, after all, is the mother of invention. So, what does this mean for the next generation of Indian startups? It means shifting focus, building for resilience. Not just hype, profit, not just pitches. Sustainability, not just scale. That's the only way to survive in a post-bubble world. Some say this is the end of an era, but we say it's just the beginning of a new one. An era of smarter, more grounded, but ultimately more successful entrepreneurship. So watch out, world, the next wave of Indian startups is coming, and it's here to stay. Like, share, and subscribe. Stay intrigued.